Hi, this is Rob Barnes with Integrated Insurance Consulting. Thank you for taking some of your time to explore the different long-term care insurance options available in today's marketplace. What we know is the national average of care can be costly. Home care can be in excess of $50,000 a year, and if you need nursing care, it can be almost double. What we don't know is if you or a spouse will need care. But both industry and government statistics tell us you have a 50-50 shot of needing at least 1 year of care if you're age 65 or over. You have a 35 to 40% shot of needing care in excess of 2 years. So if you need care, what's your plan? Who's going to care for you? How will you pay? Are you relying on your own funds, your family, the government? Or like other large risks, does it make sense to transfer some of it to an insurance carrier? If you remain self-insured, you have a potential of running out of funds depending on your care needs and the amount of assets you have. What I'd like you to do is identify which assets you'd use if in fact you needed care. And consider when we show some numbers, does it make sense to take some of those assets and leverage them into a tax-free bucket? You see, one of the things that's not always measured correctly is there could be a cost to monetize your money. In other words, if you pull money out of a qualified account or IRA to pay for care, you might need to pay taxes too. And if you're pulling money out of the stock market in a down year, you could have some realized losses in doing so. If you have legacy or charitable goals, you may want to take care of those in advance to make sure that they're done and your plans go as you plan. If you're relying on family, what happens if or when they're no longer able to care for you? And if you haven't had a family discussion, we highly recommend that you do to make sure that all parties are on board with your future plans for long-term care needs. If you're relying on the government, be aware that Medicare does not pay for care beyond 100 days, and that's only after a certain time in the hospital. The part of the government that pays is Medicaid, which causes you to spend down most of your assets. And most places that accept Medicaid payments will have a lower quality of care. So does it make sense to preserve and leverage your assets by creating a tax-free bucket of money so that you can get the quality of care when needed? Let's look at the three options. There's traditional long-term care insurance, which is pure protection. It only pays if you have a claim. There's hybrids. These guarantee to pay back at least your money and provide a larger bucket of protection as well. And then there's guaranteed life insurance with a rider. This is a known outcome, as you'll see. The traditional long-term care, for your dollar, it'll buy the biggest bucket of protection most of the time. If you live in a partnership state and buy a partnership qualified policy, there may be some additional protection against your assets. And again, no claim means no return with a traditional policy. You are exposed in most designs with most carriers and products. You are exposed to rate increases. And there's fewer options in the marketplace today for traditional than what there was a short time ago. If Jack and Jill each put $10,000 a year for the next 10 years into a traditional long-term care policy, this is the benefit pool they'd make. Now, I understand not everybody can afford $10,000 a year for the next 10 years, but the numbers are linear. So if you can do half, the bucket of protection would be half. And likewise, if you have money sitting in the bank earning next to nothing, you might want to lump sum fund and have higher benefits or save a little bit on the premium for the same bucket of protection. So you can see here, Jill's benefits and Jack's benefits are each 264,000 pool of care. That'll last for 4 years if they're using the maximum 5,500 per month. Of course, we have inflation growth here, and if they need coverage at age 80, they have almost $500,000 per person. But we've added a third bucket here called shared care. This allows either Jack or Jill to reach into that bucket. So they both could increase their protection pool by 50% if they were using half of the third bucket per person. Or if one person needed care for a longer duration, they could have up to 8 years of protection, still leaving 4 years in the other spouse's bucket. The hybrids, what we like about them is we know they're going to pay back. They guarantee the pricing. And you have the ability after a vesting period to quit and get your money back if you decide later on that you need to do so. But there's more limited funding options with hybrids. Generally, you need to fund over 1 to 10 years with rare exceptions. And all things equal, it'll take a higher premium to buy a hybrid to get to the same bucket of protection that you see in a traditional policy. So what does this look like in a hybrid? Jill puts her 10,000 in over the next 10 years. After her vesting period, she'd be able to quit and get all that back. Her minimum death benefit would be 100,000. So if she goes in her sleep and never uses a day of care, the policy will pay back her 100,000. The death benefit's a little bit higher than that in earlier years, as you'll see from any illustrations. But the real reason to buy a hybrid is the bucket of protection. She's going to instantly have 253,000 of protection day one, and that will grow. And at age 80, she'll have about 450,000 of protection, and she can use $5,900 a month if she needed care at that time. When we look at the bucket for both Jack and Jill, you can see the numbers. Jack, of course, buys a little bit more protection because women need care longer and more often than men. And so it's priced accordingly. The guaranteed life with rider option is a known outcome. It's a known death benefit and a known payback because it's going to pay whether you use care or not. And if you use a little bit of the care bucket and then pass away, it'll pay the balance of the benefit as a death benefit. It guarantees the most back out of the three options. Traditional only pays you if you have a claim. Hybrid pays back your premiums essentially are a little bit higher via the death benefit, and you only get the bigger bucket of protection if you need care. But Life with Rider is going to pay the death benefit one way or the other, as care, at death, or a combination of the two. There are some unique joint policies, but we won't be addressing those in this short presentation. And I want to emphasize we're showing you guaranteed numbers here. There's a lot of life insurance permanent chassis in the marketplace, and some are projections versus guarantees. And we think if you use a projected policy, you want to make sure that you're using conservative projections so you have no surprises later. If Jack and Jill paid the same $10,000 a year per person for 10 years, they'd buy a little over $250,000 of death benefit per person. They can use that as fast as $10,000 per month. And likewise, if Jack never needs care and he dies at age 90, beyond his life expectancy, the yield is an equivalent to a 4% net rate of return on an investment basis. It'll go lower if he lives longer and passes away at an older age. So when we look at the differences, what I'd like to highlight for you is that if you need care someday, there's two very important questions you'll ask of any insurance product you have. How much are you going to pay me, and how long are you going to pay it to me for? And so you can see the traditional bucket is a little bit higher than the hybrid, but don't forget we have that shared care. So the pool of care for the traditional is really 50% more per person if we're looking at it that way. And the traditional also offers a higher monthly benefit, as you can see, compared to the hybrid. But the Life with Rider right out of the gate offers the highest monthly amount, but the limitation is the death benefit is static and will remain static over time. So what's the right product for you to buy? We don't know. Only hindsight will tell you which one was correct. But what you want to do is go through, potential situations that may occur. First of all, you may not need care, and therefore maybe you don't want to buy any product. But which product would you buy if you never needed care? If you needed care for just a short while and then you pass, which product makes more sense? And if you think you're going to need coverage for a long time, which product would you prefer? Now, I've seen husband and wife buy different products for the right reasons. And I've even seen the same person buy a couple options just so they homogenize their risk and they don't end up at one end of the spectrum or the other. And those are all things for consideration. Don't think that it's only money that buys long-term care insurance. It's good health as well. So please don't procrastinate too long. Make your decision. And if you want coverage, buy it while you're still healthy or as healthy as you're likely to be. It is all about taking some of your money, leveraging it into tax-free dollars so that you protect the rest of your money and provide dignity and peace of mind to your family. If you have legacy goals, you may think about which product might help better with that. And again, if you're going to remain self-insured, perhaps you want to take care of your legacy planning to make sure that it happens. So the big question is, should you remain self-insured? And I don't know that answer, but I would certainly suggest that you discuss that with your advisor, and feel free to give me a call or an email to help you walk through your options and help to find out which one makes most sense for you. Thank you for taking some time to learn with us today. This is Rob Barnes with Integrated Insurance Consulting, and have a great day. Thank you.